We got a news alert here we got to get to on WeWork, the $47 billion unicorn gearing up for its IPO. It's actually We Company. Let's get to Deirdre BOSA in San Francisco for the details. Hey, Deirdre.
Hey, Melissa, WeWork releasing its first quarter financials as it gears up for an IPO. Revenue more than doubled year over year to $728 million. But the company continues to burn through hundreds of millions of dollars. Net losses were $264 million in the quarter, narrowing slightly from the same quarter last year, in part, though, due to some one-time items. Last year, though, losses grew even faster than revenue, totaling $1.9 billion. And that, guys, is more than Uber lost last year. Meanwhile, enterprise memberships accounting for 40% of total memberships now, which contributes to a larger revenue backlog as these bigger companies typically sign longer contracts. Artie Minson and Vice Chairman Michael Gross telling me on the phone just earlier that the company is in spending mode for its long-term growth. Minson also urged me to look at losses as investments because he said that co-working is a proven business model. And guys, that may hint at the narrative the company will sell to Wall Street as it heads towards its IPO, trying to distance itself from other money-losing unicorns like Uber and Lyft. Now, I did ask if their plans had changed since Uber and Lyft's disappointing debuts. Minson avoided a direct answer, but he did say simply that he believes the market will evaluate each company individually. We'll see if that's the case. Back to you.
All right, Deirdre. Thank you, Deirdre BOSA. I find it interesting that they say that co-working is a proven business model when they're losing gobs of money here. I mean, in this market environment, after Uber, after Lyft, after their trading, which has been so disappointing, Dan, is there going to be any appetite for this one?
It's going to be hard. I mean, it's going to be hard anytime soon. And I think that, here's the thing. I mean, obviously, this has been a very transformative company, the way we would have said Lyft and Uber are. I think the fact of the matter is that private investors have really liked this sort of innovation, and they've been willing to underwrite it. Public investors right now have shown us they are not willing to do that, especially for a company that has a metric that's called community-adjusted EBITDA. So
what the heck is that?
Well, that's one of the metrics.
You take out the losing part, and then you just leave.
And then you have the really good winning part.
But listen, there's a lot of talk. I mean, listen,
winning.
This company is building a huge real estate portfolio, and then they have this tech platform. So
talk about interest rate sensitive, though. I mean, it seems to me that this is a company that would be more sensitive to an economic downturn than anybody. That's just me.
Right.
I think the reality is you've got to show us a path to making money. Uber hasn't shown us that. Lyft hasn't shown us that. Do these guys have any chance?
Losses are investments.
Right. Well, that's why I look at all these and I can't wait for puts to come out. I can't wait for the options to be delivered because I think all of these things have a lot more downside even from here.